Let me tell you about 3 people. None of them are real, but all of them are true. First, there's Michael. 63 years old, retired in September 2008 with $1.4 million in his 401k. Did everything right. Maxed out contributions for 22 years. Stayed the course through the dot-com crash. Diversified, low fees, the whole package. Then September 2008 happens, Lehman collapses, his portfolio drops 37% in 4 months. He panicked. Sold everything in February 2009 and moved to cash. Missed the entire recovery. By 2016, his $1.4 million had withered to $680,000. He's 71 now, working part-time at a hardware store. Second, there's Susan. 67 years old, retired in 2015 with $1.6 million. She owned a successful dental practice, sold it, invested the proceeds in a mix of dividend funds and bond funds. Seemed safe. Problem was, her financial advisor put her in high turnover, actively managed funds without explaining what that meant for her taxes. In 2018, her funds distributed $43,000 in capital gains. No warning, no input from her, just a tax bill. That distribution pushed her adjusted gross income over the IRMAA threshold. Her Medicare Part B premiums jumped from $134 per month to $187.50. That's $642 extra per year. Over 20 years, that's $12,840. And here's the kicker. Every year her funds distributed gains, she got pushed back over. She's still paying elevated premiums. Third, there's Robert. 73 years old, retired at 60 with $2.1 million. The dream, right? He was so focused on building that number that he never did Roth conversions. Never thought about tax brackets in retirement. Just accumulated. Now he's 73, and required minimum distributions are forcing him to withdraw about $92,000 per year from his pre-tax accounts. Add in Social Security, and his taxable income is pushing $140,000 annually. He's paying more in taxes now than he did when he was working and earning $95,000. His effective tax rate in retirement, higher than his marginal rate was during his peak earning years. 3 people, all did what the financial industry told them to do. Max out retirement accounts, stay invested, diversify. All had substantial nest eggs, all got crushed. So here's the question. What killed their retirement? Was it bad luck? Bad timing? Bad markets? No. That's what the financial industry wants you to think. That's what keeps you paying for advice, for management, for products that promise to protect you from the thing that got Michael, Susan, and Robert. The problem isn't luck or markets or timing. The problem is that the exact same mindset that builds wealth from 30 to 60 will destroy it from 60 to 90. Accumulation mode and distribution mode are not the same game. They're not even the same sport. But most people, and I'd argue most financial advisors, treat them identically. Build a big pile, don't touch it, let it grow, withdraw what you need. Simple. It's not simple, it's a trap. Look, I've spent the last decade reading SEC filings, tax code sections that would make your eyes bleed, and retirement distribution studies from academics who have never met an actual retiree. And I can tell you this, almost all mainstream retirement advice is built for accumulation. 401k contribution limits, compound interest calculators. Start early, stay invested. All designed to get money in. Almost nothing is designed for getting money out efficiently. Here's the shift that nobody talks about. Before retirement, your primary goal is growth. After retirement, your primary goal is control, not returns, not yield, not beating the market. Control over when you realize income, how much you realize, and what tax bracket you land in. The same discipline that got you to $1.5 million by age 62 becomes the trap that destroys your retirement if you don't fundamentally change your strategy. I want to introduce you to a framework, a way of thinking about retirement accounts that fixes this problem at the structural level. I call it the retirement sound system. Imagine a professional audio setup. You've got 4 layers of speakers, subwoofers for the deep bass, mid-range drivers for vocals, tweeters for the high frequencies, and then the overall system EQ that balances everything. Each layer does something different. Each layer has to be tuned correctly. And here's the critical part. If one speaker blows out and starts feeding static into the system, it doesn't just affect that speaker, it distorts the entire sound. The whole system suffers. Your retirement portfolio works the same way. You have 4 layers of accounts, each with a different job, each creating a different type of income, each subject to different tax treatment. When they're balanced correctly, you get smooth, predictable income with minimal tax drag. When one layer is misconfigured, it creates interference that cascades through the entire system. Layer 1, the shock absorber. This is your cash buffer, 2 years of living expenses held in safe, liquid instruments. It exists for one reason: to prevent you from selling equities during a market crash. Layer 2, the stealth layer. This is your taxable brokerage account, and it's where most people accidentally create uncontrolled income through dividends and capital gains distributions. Properly configured, it generates tax-efficient income you can control. Layer 3, the Roth Window. The 13-year period between ages 62 and 75, where you can strategically convert pre-tax money to Roth, controlling your future tax burden instead of letting the IRS control it for you. Layer 4, the tax map. Asset location, putting the right investments in the right account types based on how they're taxed. High growth assets in Roth, bonds in pre-tax, tax-efficient funds in taxable. 4 layers, one system, below one speaker, and the distortion feeds through everything. Before we dive in, I should mention that I've built a calculator for this. It's free, no email required, runs the math on sequence of returns risk, Roth conversion windows, and IRMAA bracket management. You plug in your numbers, it shows you the damage from getting this wrong versus getting it right. Link is in the description. Not trying to sell you anything, I just built a tool I wished existed when I was figuring this out for myself. Now let's talk about layer 1, the shock absorber. And to explain why it matters, I need to tell you about Gerald. Gerald isn't real, but his situation is. He retired in December 2007 with $1.5 million. Perfect timing, right? The market was at an all-time high. He'd done everything correctly. 37 years of saving, investing, rebalancing. His advisor told him he was set. Safe withdrawal rate of 4% gave him $60,000 per year to live on. He figured he'd be fine. Here's what actually happened. 2008. The S&P 500 drops 38%. Gerald's portfolio, which was 60% stocks and 40% bonds, drops about 22%. Still, he needed $60,000 for living expenses. Where does he get it? He sells from his equity funds because they're down, and his advisor always said, rebalance when your allocation drifts. His equity allocation had drifted down from 60% to about 45% because bonds held value better. So he sold equities to rebalance and generate cash. Let me show you the math, because this is where it gets ugly. Start, $1,500,000. 60% equities, $900,000. 40% bonds, $600,000. After 2008 crash, equities dropped 38% from $900,000 to $558,000. Bonds actually gain a bit, let's call it 4%, so $624,000. Total portfolio value, $1,182,000, down about 21%. But Gerald needs $60,000 to live. He sells from equities because that's what the rebalancing logic says to do. He sells approximately $95,000 worth of equities to get back to target allocation and generate his living expenses. End of 2008, he has $463,000 in equities and $659,000 in bonds. Total $1,122,000. 2009 comes along, market recovers 26%. Great, right? Gerald's equities recover. $463,000 grows to $583,000. His bonds tread water. His portfolio is now about $1,242,000. Now here's the critical question. What would his portfolio be worth if he hadn't needed to withdraw during the crash? Same starting point, same crash, same recovery. But instead of selling, he had a cash buffer. Let's run it. Start, $1,500,000, $900,000 equities, $600,000 bonds, 0 cash. But wait, in this scenario, we're saying he has a cash buffer. So really, let's back up. He should have started retirement with 1,350,000 invested and 150,000 in cash, 2 years of expenses. Okay, so 1,350,000 invested, 810,000 in equities, 540,000 in bonds, plus 150,000 cash. 2008 crash, equities dropped 38%, from 810,000 to 502,000. Bonds gained 4% to 562,000. Total investments, 1,064,000, plus 150,000 cash still sitting there. Total wealth, 1,214,000. Gerald spends 60,000 from cash. End of 2008, 1,064,000 invested, 90,000 cash. Total wealth, 1,154,000. Already he's ahead compared to 1,122,000 in the first scenario. 2009, market recovers 26%. His 502,000 in equities grows to 632,000. Bonds tread water at 562,000. Total investments, 1,194,000, plus 90,000 cash. Total wealth, 1,284,000. After one crash and one recovery year, Gerald with the cash buffer has 1,284,000. Gerald without the cash buffer has 1,242,000. Difference, $42,000. That doesn't sound catastrophic, but here's where it compounds. Fast forward to 2019. After a decade of withdrawals and market cycles, Gerald without buffer has a portfolio worth approximately $890,000. Gerald with buffer has a portfolio worth approximately $1,160,000. Same market returns, same spending. The only difference is that Gerald with buffer never had to sell equities during the crash. He let his equities recover before touching them. That 2-year cash buffer, call it $120,000 to $150,000, for someone spending $60,000 annually was worth $270,000 over 12 years. The buffer itself was the best investment he ever made, even though it earned almost nothing in interest. This is what researchers call sequence of returns risk, and it is the single most misunderstood danger in retirement planning. Sequence of returns risk is the mathematically brutal reality that the order of your returns matters as much as the average of your returns. If you get great returns early in retirement and bad returns late, you're fine. If you get bad returns early and great returns late, you might never recover. Why? Because you're withdrawing money. When markets are down and you withdraw, you lock in losses. You sell more shares to generate the same dollar amount. Those shares are gone forever. They can't participate in the recovery. The industry talks about safe withdrawal rates as if returns are smooth averages. They're not. They're volatile sequences. And the sequence you happen to get in the first 5 years of retirement can determine whether your money lasts 30 years or 15. Let me give you some numbers from actual research. A study by Michael Kitzes and Wade Pfau looked at the impact of valuation and sequence on retirement outcomes. They found that a retiree starting with a 4% withdrawal rate in a low valuation environment had a near zero chance of depleting their portfolio over 30 years. But starting in a high valuation environment, that same 4% withdrawal rate had a nearly 50% failure rate. Same withdrawal rate, same historical average returns, different sequence, different outcome. Think about that for a second. The 4% rule that every financial advisor quotes, that's based on historical data, but the actual sequence you experience could make that rule completely wrong for you personally. Half the time, roughly, you'd be fine. Half the time, you'd run out of money. Coin flip. And here's the psychological trap. The times when the market is high and valuations are stretched, those are exactly the times when people feel richest and most comfortable retiring. They look at their portfolio statement, see a big number, and think, I've made it. That big number is precisely when the risk is highest. Now, you might be thinking, okay, but I can't predict when crashes will happen. What am I supposed to do? Time the market? No, you don't have to time the market. You just have to stop forcing yourself to sell at whatever price the market happens to be offering on the day you need cash. This is where the shock absorber comes in. The shock absorber is simple. 2 years of living expenses held in cash or near cash instruments. Money market funds, short-term treasury bills, high yield savings accounts, FDIC insured, minimal volatility, immediate liquidity. It's not an investment, it's insurance. The purpose of the shock absorber is to give you optionality. When markets crash, and they will, that's not a prediction. That's a fact of markets. You don't have to sell equities. You spend from the shock absorber while equities recover. Then, when markets have recovered, you refill the shock absorber from your equity gains. Let's run the math on someone spending $60,000 per year. 2 years of expenses equals $120,000. Maybe round up to $150,000 to be safe. Hold that in a money market fund. As of early 2026, money market yields are around 4%. So that $150,000 is generating about $6,000 per year in interest. Not exciting, but not nothing. Now, the question I always get, isn't that inefficient? Cash drag? Why hold $150,000 earning 4% when the stock market averages 8 to 10%? Two responses. First, the cash drag argument assumes you're comparing cash to a smooth 8% return. That's not how markets work. Markets crash, sometimes for years. If your cash buffer prevents you from selling during a 30% drawdown, the cost of holding cash is negative, you've actually saved money. Second, think about it like insurance. Homeowners insurance costs money. You pay premiums every year. You hope you never use it. But if your house burns down, you're glad you had it. The shock absorber is portfolio insurance. The premium you pay is the opportunity cost of holding cash. But when the market crashes and you're the only person on your street not panic selling at the bottom, you'll be glad you had it. Here's a way to think about it. The financial industry loves to show you compound interest charts. If you'd invested $10,000 in the S&P 500 in 1980 and never sold, you'd have. Yes, correct. But that assumes you never needed to withdraw. Retirement is different. You are withdrawing. The math changes completely when there's an outflow. Some specific numbers for the shock absorber. Target amount, 24 months of expected expenses. If you're spending $5,000 per month, that's $120,000. If you're spending $7,500 per month, that's $180,000. Where to hold it? Money market funds like Vanguard Federal Money Market or Fidelity Government Money Market, currently yielding around 4%. Or high-yield savings accounts from places like Marcus, Ally, or Capital One, currently around 3.8 to 4.2%. Or short-term treasury bills, 3 to 6 month durations, purchased directly through Treasury Direct or your brokerage. What not to hold? Long-term bonds, interest rate risk, CDs with early withdrawal penalties, liquidity risk, stocks obviously, or any high-yield product that isn't principal protected. This is not complicated. It's boring. Boring is the point. When do you use it? When your equity investments are down more than, say, 15% from their recent high. That's the trigger. At that point, you stop selling equities and start spending from the shock absorber. When do you refill it? When markets recover. You don't try to time the bottom. You just wait until your equity allocation has recovered, then gradually sell from equities to bring the cash buffer back up to 24 months of expenses. This creates a mechanical discipline that removes emotion from the decision. You're not guessing whether the market will go up or down. You're following a rule. If equities are down significantly, don't sell them. The psychology here matters as much as the math. Because when markets crash, your brain does weird things. You see your portfolio down 30%. Every financial news outlet is screaming about the end of capitalism. Your brother-in-law is telling you about how he moved to gold in 2008 and was vindicated. The pressure to do something is overwhelming. Having a pre-committed plan specifically, a cash buffer that exists for exactly this situation, gives you permission to do nothing. You already planned for this. You have money to spend. You don't need to sell. You can watch the chaos from a position of stability. Now you might be thinking, what if the crash lasts longer than 2 years? What if we get a lost decade like Japan? Fair question. First, 2 years of cash gets you through most corrections. The 2008 crash bottomed in March 2009, about 17 months from peak to trough. The 2000 dot-com crash took about 31 months to bottom, but the recovery was faster than people remember. Second, if we genuinely get a lost decade, 10 years of flat or negative returns, no withdrawal strategy saves you. The 4% rule fails. every rule fails. At that point, you adjust your lifestyle or go back to work. But 2 years of cash gives you 2 years of runway to figure that out without panic selling at the worst possible moment. Third, you can always extend the buffer. Some people prefer 3 years. A few go to 5. There's a trade-off between safety and opportunity cost. I think 2 years is the sweet spot for most people, enough to get through typical crashes. Not so much that you're massively underinvested. Now let's go back to our 3 failed retirees from the beginning. Michael, who panicked in 2008, would a shock absorber have saved him? Maybe not entirely, because he made an emotional decision to sell everything. But having a plan, having cash to spend, having the mechanical discipline already in place, that might have given him enough psychological breathing room to not make the worst decision of his life. The shock absorber is layer 1. It's foundational. Without it, every other layer of your retirement sound system is vulnerable. Because if you're forced to sell equities during a crash, the tax-efficient placement of your bonds doesn't matter. Your Roth conversion strategy doesn't matter. You've already locked in catastrophic losses. But here's where most people blow the second speaker without knowing it. Layer 2 is your taxable brokerage account. And I call it the stealth layer because it's silently generating income you didn't ask for, at tax rates you didn't choose, triggering costs you didn't see coming. Here's a scenario. You've got $350,000 sitting in a taxable brokerage account. Maybe it's from an old employer's stock purchase plan or RSUs that vested over the years, or just money you saved outside of retirement accounts. You invested it in what seemed like a reasonable choice. A diversified, actively managed fund from a reputable company. Maybe something with dividend growth or equity income in the name. Sounded good. Companies that pay dividends are stable, right? But here's what's actually happening inside that fund. Actively managed funds have turnover. The fund managers are buying and selling stocks throughout the year. Sometimes they have to rebalancing, responding to market conditions, chasing performance. Sometimes they want generating transaction fees for the brokerage, justifying their active management fee. When a fund sells a stock at a gain, that gain doesn't stay inside the fund. It gets distributed to shareholders, you. And when it gets distributed, you owe taxes on it. Whether you wanted that income or not, whether the timing was convenient or not, whether you'd rather have left the money invested or not, this is what I call uncontrolled income. You didn't decide to realize gains. The fund manager decided. You didn't choose when to trigger the tax event. The fund's trading desk chose. You're just along for the ride, signing the check to the IRS. Let me put some concrete numbers on this. A typical actively managed equity fund has turnover of about 50 to 80% per year. That means over half the portfolio changes annually. Vanguard's actively managed funds run lower turnover, maybe 20 to 30%. But some funds, particularly small cap funds, sector funds, funds chasing momentum, can have turnover exceeding 100%. The entire portfolio turns over every year. Now let's say your $350,000 is in a fund with moderate turnover and a dividend yield of about 2%. You're getting about $7,000 in dividends annually. Qualified dividends, so tax at 15% for most people, that's about $1,050 in taxes. Not catastrophic. But wait, this fund also distributed capital gains. The managers had a good year, sold some winners, and now they're distributing $12,000 in long-term capital gains to all shareholders. You didn't sell anything. You didn't choose to realize those gains. But there they are on your 1099 DIV. Now, your total distributions are $19,000. Add that to your other income. Let's say you have $50,000 from a part-time consulting gig, plus maybe $20,000 from Social Security if you've started claiming. Suddenly, your adjusted gross income is creeping up. And here's where it gets really interesting. Once you're on Medicare, there's this thing called IRMAA, Income-Related Monthly Adjustment Amount. It sounds boring. It's not. IRMAA is the government's way of charging wealthier retirees more for Medicare Part B and Part D. The thresholds are based on your modified adjusted gross income from 2 years prior. So your 2026 income determines your 2028 Medicare premiums. For 2026, the standard Part B premium is about $185 per month. But if your MAGI exceeds $106,000 for an individual or $212,000 for a married couple filing jointly, you hit the first IRMAA tier. Your premium jumps to $282.30 per month. That's an extra $97.44 per month. Over 12 months, that's $1,169.28. Over 20 years of retirement, that's $23,385.60. And that's just the first tier. The threshold stack, $133,000 MAGI, you're at the second tier. $160,000, third tier. All the way up to income above $500,000, where your Part B premium is almost $600 per month. But wait, remember those fund distributions? The ones you didn't ask for? Let's say you're right at the edge of an IRMAA threshold. Your income is $103,000. You're safely below the first tier. Then, your actively managed fund decides to distribute $14,000 in capital gains because they rebalance the portfolio. Your income is now $117,000. You've crossed the threshold. Your Medicare premiums jump for the following year. You're paying almost $1,200 more annually because a fund manager made a trading decision. For a married couple, these numbers double. The threshold is higher, but so is the potential penalty. Cross into a higher tier, and you're both paying elevated premiums. Now here's the truly maddening part. IRMAA is calculated on modified adjusted gross income, which includes tax-exempt interest. So even municipal bonds, often touted as tax-free income, still count toward your IRMAA thresholds. Federally tax-exempt, yes, but MAGI visible. The government still sees it. This is why I call it the stealth layer. Your taxable account is quietly, invisibly pushing you over thresholds you didn't even know existed. The fix isn't complicated, but it requires abandoning some entrenched habits. First, audit your taxable account for uncontrolled income sources. Look at your last 3 years of 1099 forms. How much came from dividends versus capital gains distributions? What's your average annual distribution from each fund? Second, shift toward tax-efficient investments in your taxable account. Index funds with low turnover, Vanguard Total Stock Market, Schwab Total Stock Market, Fidelity Zero Total Market. These funds have turnover under 5%. They almost never distribute capital gains because they're not actively trading. When you want to realize gains, you sell shares. You control the timing. You choose when to trigger the tax event. Third, consider municipal bonds for the fixed income portion of your taxable account. The interest is federally tax-free. But remember, they're still visible for IRMAA calculations. So don't go crazy. Use them strategically, not blindly. Fourth, if you have highly appreciated individual stocks with low dividend yields, consider holding them. The unrealized gains aren't taxed until you sell. You control that timing. And when you die, your heirs get a step up in basis, meaning those unrealized gains disappear. The IRS loses that tax revenue entirely. This is one of the most powerful estate planning tools available, and almost nobody talks about it. Let me give you a mock conversation that illustrates the problem. You, hey, dividend fund. How's it going? Dividend fund. Great, I made some trades, sold some winners, distributed $12,000 in capital gains to you last year. You, wait, I didn't ask for that. I wanted to leave the money invested. Dividend fund. Sorry, that's not how this works. I decide when to realize gains. You just pay the taxes. You, but this pushed me over an IRMAA threshold. My Medicare premiums are going up. Dividend fund. That sounds like a you problem. That's essentially the relationship. The fund manager makes decisions based on what's good for the fund or what generates transaction fees for the brokerage, and you deal with the downstream consequences. Now, if you want a truly cynical observation, here's one. Financial advisors often put bond funds in Roth IRAs and stock funds in taxable accounts. Sounds reasonable, right? Bonds are stable, Roths are for long-term growth. Let's match them up. This is backwards, and it drives me insane. Bonds generate ordinary income, which is taxed at your highest marginal rate, up to 37% federally, plus state taxes. Stocks generate qualified dividends and long-term capital gains taxed at 0, 15, or 20%, depending on your income. Qualified dividends and capital gains are preferentially taxed. Ordinary income from bonds is not. So where do you want your bonds? In pre-tax accounts like traditional IRAs and 401ks, where all withdrawals are taxed as ordinary income anyway. You're going to pay ordinary income rates regardless. Might as well hold the asset that generates ordinary income. Where do you want your highest growth assets? In Roth accounts. Because all the growth comes out tax-free. The more growth you get in a Roth, the more tax-free income you have later. Where do you want tax-efficient stock funds? In your taxable account. Because you can harvest losses, you control when gains are realized, and qualified dividends get preferential tax treatment. This brings us to layer 3, the Roth window. There's a 13-year period between age 62 and 75 that I consider the golden window for retirement tax planning. This is the only time in your entire financial life when you have complete control over your taxable income without being forced to take distributions. Before age 59 and a half, accessing retirement accounts triggers early withdrawal penalties. After age 73, rising to 75, under the Secure Act, 2.0 required minimum distributions force you to withdraw from pre-tax accounts whether you want to or not. But between 62 and 75, you're in the sweet spot. You can convert as much or as little as you want from pre-tax to Roth, paying the taxes now to avoid higher taxes later. Let me introduce you to Martha. Martha retired at 62 with $1.8 million, $1.2 million in pre-tax accounts, $400,000 in Roth, $200,000 in taxable. She figured she'd just let everything grow and deal with taxes later. Seems simpler. Fast forward to age 73. Her pre-tax accounts have grown to $1.6 million because she didn't withdraw from them. She lived on Social Security and her taxable account. Now RMDs kick in. The Uniform Lifetime Table says her distribution period is 26.5 years. Divide 1.6 million by 26.5, and her first RMD is about $60,000. Add Social Security, let's say she's receiving $35,000 annually. Her taxable income is now $95,000 from those two sources alone. She's in the 22% bracket, approaching the 24% bracket. But here's the real problem. Her RMDs will increase every year as a percentage of her remaining balance. By age 80, she's withdrawing over 6% annually. Her pre-tax balance is still large because it grew during her 70s. She's now being forced to withdraw over $90,000 per year. Combined with Social Security, her taxable income exceeds $130,000. She's solidly in the 24% bracket, potentially hitting IRMAA thresholds. Martha is paying more in taxes at age 78 than she paid at age 55 when she was still working and earning $120,000 annually. Her effective tax rate in retirement is higher than during her peak earning years. This is the RMD trap. The government designed RMDs to force you to withdraw from pre-tax accounts so they can collect tax revenue. They're not trying to help you. They're trying to get paid. Now, let's look at what Martha could have done differently. Between ages 62 and 75, she had 13 years to systematically convert pre-tax money to Roth. Let's say she converted $80,000 per year from her pre-tax accounts to her Roth. At age 62, assuming she had minimal other income, that $80,000 would be taxed at 12% after the standard deduction. Most of it falls in the 10 and 12% brackets. 12% of $80,000 is $9,600 in taxes. Over 13 years, she could have converted over $1 million from pre-tax to Roth. Let's say the actual converted amount, accounting for some growth and market fluctuation, totals around $1.1 million. At an average tax rate of 15%, some years at 12%, some at 22%. As the conversions pushed her into higher brackets, she would have paid about $165,000 in taxes during those 13 years. Now she's 73. Her pre-tax balance is dramatically smaller, maybe $300,000 instead of $1.6 million. Her RMD is about $11,000. Her Roth account has grown to over $1.5 million, and she never has to take RMDs from it, ever. All withdrawals are tax-free. She paid $165,000 in taxes over 13 years to avoid paying who knows how much in RMD taxes over the rest of her life. Easily $300,000 or more, especially when you factor in IRMAA surcharges she would have triggered. This is tax bracket arbitrage. You pay taxes at lower rates now to avoid paying at higher rates later. But it only works if you have the cash buffer, the shock absorber, to pay the conversion taxes from outside your retirement accounts. If you withdraw from your pre-tax account to pay the conversion tax, you've defeated the purpose. Remember layer 1? This is why it matters. Your shock absorber isn't just for market crashes. It's also for Roth conversion taxes. The math gets even more interesting when you consider that tax rates are historically low. The Tax Cuts and Jobs Act of 2017 lowered rates across the board, but those provisions expire after 2025. Congress may extend them, modify them, or let them revert to higher rates. Nobody knows. But I'd rather pay 12 or 22% now than gamble on what rates will be in 15 years. This is where I need to be clear. I'm not telling you to convert everything to Roth. Roth conversions aren't always optimal. If you expect to be in a lower tax bracket in retirement than you are now, which is true for some people, then traditional pre-tax contributions and letting the money grow tax-deferred makes sense. The math depends on your specific situation. But here's what I see over and over. People accumulate $1 million, $1.5 million, $2 million in pre-tax accounts and have almost nothing in Roths. They've created a massive future tax liability. And RMDs force them to recognize that liability, whether it's convenient or not. The Roth window is about options. Converting strategically gives you flexibility later. Money in a Roth is money you can withdraw without affecting your tax bracket, without triggering IRMAA, without pushing you over any thresholds. It's the cleanest money you'll ever have. Now let's talk about layer 4, the tax map, asset location. This is where everything comes together. You've got your shock absorber layer 1, protecting you from sequence risk. You've got your stealth layer, layer 2, configured to generate controlled, tax-efficient income. You've got your Roth conversion plan, layer 3, shrinking your future RMD burden. Layer 4 is about putting the right investments in the right accounts. The principle is straightforward. Different investments are taxed differently. Different account types have different tax treatments. Match them optimally. High growth assets, small cap stocks, emerging markets, sector funds, individual growth stocks go in Roth accounts. You want maximum growth in accounts where all the gains are tax-free. If a small cap fund triples over 15 years, you want that 200% gain completely tax-free. Bonds and fixed income investments go in pre-tax accounts. Bonds generate ordinary income, which is taxed at your highest marginal rate. Pre-tax accounts, like traditional IRAs, tax all withdrawals as ordinary income anyway, so hold bonds there. You're not wasting the preferential tax treatment of qualified dividends and capital gains on assets that don't generate them. Tax-efficient stock funds, broad market index funds, tax-managed funds, low turnover funds go in taxable accounts. You can harvest losses when the market drops, offsetting gains elsewhere. You control when to realize gains. Qualified dividends are taxed at preferential rates. And if you hold appreciated stocks until death, your heirs get a step up in basis. Here's a real example. Let me tell you about Jim. Jim retired in January 2020 with $1.6 million. He'd watched the market run up in 2019 and was nervous about valuations. But he'd also been nervous for 5 years and didn't want to try timing his retirement based on market levels. Reasonable. What Jim did have was a shock absorber. $150,000 in a high-yield savings account earmarked for living expenses. His plan was simple. Spend from cash for the first 2 years, let the portfolio ride, and reassess if markets dropped. Then March 2020 happened. COVID. The S&P 500 dropped 34% in 23 trading days. Fastest bear market in history. Jim's portfolio went from $1,450,000 invested to about $960,000. His brother called him in a panic. We have to sell. This is different. The economy is shutting down. No one knows when it ends. Jim's brother sold everything on March 23rd, 2020, the exact bottom. Jim did nothing. He spent from his shock absorber. He watched his portfolio drop, then recover. By June, markets had recovered most of their losses. By year end, Jim's portfolio was above where it started the year. His shock absorber was depleted, about 90,000 left, but his portfolio had recovered. He spent the next 2 years gradually refilling the cash buffer by selling from equities when markets were up. Jim didn't do anything brilliant. He didn't predict the crash. He didn't time the recovery. He just had a system that removed the need to make decisions under pressure. The shock absorber gave him permission to do nothing while everyone else was panic selling at the bottom. Now, 5 years later, Jim's portfolio is worth about $1.9 million. His shock absorber is fully refilled. He's systematically converting $50,000 per year from pre-tax to Roth, paying taxes from his cash buffer. His RMD burden at 73 will be manageable because he's shrinking his pre-tax balance now. This is what a functioning retirement system looks like. Not genius, not perfect market timing, just structure. So let me give you 3 practical takeaways. 1, build your shock absorber first. Before you worry about tax optimization, before you run Roth conversion scenarios, before you think about asset location, make sure you have 2 years of living expenses in safe, liquid instruments. This is non-negotiable. Without it, every other piece of your plan is vulnerable to sequence risk. 2, audit your taxable account for uncontrolled income. Pull your last 3 years of tax returns. Look at the 1099 forms. How much income is being forced on you by fund distributions? If it's significant, consider shifting toward low turnover index funds where you control when gains are realized. You're not trying to avoid taxes, you're trying to control the timing. 3, run the Roth conversion math before RMDs arrive. Use a calculator, mine, or anyone else's. Project your pre-tax balance at age 73 under different conversion scenarios. See what happens to your tax burden if you convert versus if you don't. The window between 62 and 75 is finite. Every year you wait is a year you can't get back. Here's the cynical truth. The IRS loves passive investors. They love people who let fund managers distribute gains without considering the tax consequences. They love people who accumulate in pre-tax accounts without planning for RMDs. They love people who trigger IRMAA surcharges because they didn't manage their MAGI. Every dollar you pay in avoidable taxes, every premium surcharge you trigger unnecessarily, every Roth conversion window you waste, that's the system working exactly as designed. The tax code is not neutral. It rewards certain behaviors and punishes others. Most people don't know which is which. Lazy investing built more fortune than crypto memes. But lazy doesn't mean passive. It means designing a system that works automatically, that doesn't require constant attention or brilliant decisions. A system where doing nothing is often the right move because you planned for it in advance. 4 layers: shock absorber, stealth layer, Roth window, tax map. Get one wrong, the distortion feeds through everything. Get them all right, and you've built something most retirees never have: actual control over your financial outcome.